Welcome to my Accounting 1120 continuing discussion on investments. In this late at night pincast, I'm going to do a comparison of accounting for the different categories of investments that you can make as an investor. This is tackling it from a little different order than the book. We're going to do this overview first. And again, we're going to do accounting for trading and available for sale, and then hold to maturity, and then hold to the equity method. Now that sounds like Greek right now. But I think if we lay it out like that, and I use this format and stay through the whole chapter, that I'll have a lot of success with you. I've done this before and it works well. So the first thing I want to do is look at the category of investments that we have. Talk a little bit about the first kind of category that we have. This is really new law. It's not that old. Either that or I'm getting old. And this category is for trading investments. The definition of a trading investment will help be understood if you look at how I'm going to classify on the balance sheet. Trading investment is always short-term. There's an abbreviation there. Trading as investment is one. Let me describe it and you'll see what I mean. It can be in a bond that's going to mature right away, or it can be in stock, so it can be either type. In my example, I'm going to use stock. And it's very short term. When I say short term, I mean it's management's intent to dump it. Certainly with the definition of a current asset, one accounting period or an operating cycle, whichever is longer. But it's very short, and management's intent is to dump it right away. You are only holding it. You only got into it and you're going to get out of it, and your whole idea was to snag a gain the way the market's behaving. Let's compare that to another category called available for sale. Available for sale investments can be short-term or long-term. They can go either way. So they can be short-term or long-term. And again, they can be in bond or stock. But I'm going to keep it the discussion on stocks. And it's kind of a catch-all. If management isn't sure the stock fits in trading, then they'll default to available for sale. It's kind of the default. And again, it's done on management's intent. And if you're going to sell it within 9 months, then you could call it short term. Or if you're going to sell it hold it for a long time, then you'll call it long term. It's all done on management intent. Now, the nice thing about trading investments and available for sale investments is the accounting's the same. We record them at cost in both cases. Since we're going to do stock, we recognize dividend revenue when it's declared. The same in both cases. But there is one difference, but not yet. At the year end, we adjust it to market value. So at year end, we adjust it to market value. And the adjustment on a trading investment gets put on the income statement. How big I wrote that. You actually record a gain on the income statement at year end. But you do a year-end adjustment, and it looks for the world as the same to market value, unavailable for sale, but it skips the income statement and it goes into comprehensive income. And comprehensive income lives in stockholders' equity under accumulated comprehensive income. So when we learn the accounting for one, we'll learn the accounting for the other. And it's perfectly the same right up to that last year-end adjustment. So we have trading for really short term and available for sale for longer term or catch-all. And I'm going to have another category, and it's going to be called hold to maturity. Obviously, I'm not talking about stock, so I'm talking about bonds here, because stock does not have a due date. And it can be short-term if the bond matures that year, but by and large, it's usually going to be long-term, because we hold bonds for 20 or 30 years. So in our hold to maturity category, it's probably going to be a long-term investment, and it's always going to be in bonds, because bonds have a maturity date. Stock does not. We can't do anything off a maturity date on stock. It doesn't have one. We do everything off management's intent. Now on hold to maturity, we've been looking at the accounting. I should label this. And we record the bond at cost, and if we bought it at a premium or discount, we're going to amortize it. And you can amortize it using straight line or the effective method. On short term, it doesn't make a big difference. On long term, it would. But I have good news for you. In this chapter, I'm going to do all of my recording for bonds at par. I want you to know that if there was a premium or discount, we would amortize it using straight line or the effective interest method. But we're just going to do par. Good news, huh? And if there's any year-end adjustment at all, it would be to pick up any interest that we have earned but haven't been paid yet. And we do not mark these to market value. We do not make a year-end adjustment to market value, because there isn't going to be a sale of this bond at a gain or a loss. It's irrelevant. We're going to hold it to maturity. So hopefully that makes sense to you. The next category that we are going to look at is equity method. I didn't spell that well. Equity method, also sometimes is called the significant influence method. And it gets its name, you'll understand in a minute. First of all, it's always long-term, it's never short-term, and it's always an investment in common stock. And we have acquired enough of the common stock of this corporation that we have significant influence, hence the name, on their operating. So we are trying to influence their decision-making. So we bought common stock, and it has to be common because we want it to vote. You can't have any influence, and then we want to influence what they do. Now, you don't get into this kind of a relationship on the short term, so it's always long term. And the good news is, once again, we record it at cost, but then the accounting gets really different from what we've learned in the other 3 categories. So erase your mind on this, and we'll use the equity method of accounting, and it's too much to go into here. So I'm just going to give you a little taste. We do to our investment account anything that the investee does to stockholders' equity. So whatever they do that makes stockholders' equity bigger, we increase our investment. They have revenue, that makes it bigger. So we pick up a share of their revenue and call it revenue. Weird. They pay a dividend, that makes them smaller. So we'll credit dividends out of our investment account. It's just a real different creature. So there are year-end adjustments for this one. We pick up some of their revenue. We take out our dividends if we didn't already during the course of the year, and it might not be a year-end adjustment. But just like hold to maturity, we do not revalue to market value. We do not do that. So those are some of the methods. There's one more I want to mention quick, and that's consolidations. Consolidation accounting is a technique you use when you own over 50% of a business and you don't have significant influence. You have controlling influence. I want to go back to significant influence and say this is suggested somewhere between 20 and 25% ownership, and I'm always going to tell you when you have significant influence, but when you're looking at consolidations, your ownership is greater than 50%, 50.1, and you are in control. Again, it's long-term, and it's in the company's common stock. You pretty much have a takeover happening here, hostile or otherwise, and you're not influencing, you're controlling. The type of accounting that gets done is consolidations, and here's the good news. Consolidation accounting is taught in advanced accounting, so we won't be covering this. You do need to know that it's one of the type of investments, but it's not something that we're going to worry about. So, we have trading investments. There's my fuzzy little line, which is really similar to how you do the accounting for available for sale, with one tiny difference, and that is where the adjustment to market value goes. Everything else is the same. We're going to do stock on that, and then look at maturity, hold to maturity, and clearly that's bonds. And we did it in the last chapter, and it's going to take 30 seconds because we're doing it on par value only. And we're going to look at significant influence. And I don't know what there is about that one, but I think it's really cool. I like the relationship of that one. This is where we're going to go in the next few chapters. And now I'm going to stop this discussion. In the next pencast, I'll go into trading and available for sale. I'll do hold to maturity probably by itself, and significant influence by itself. Wrap it up and we'll be done. And it's still just getting later. Hopefully I'm not talking too soft and you can hear me. So, you want to print this one and think about it as we move forward. And let's keep it on. Good night. It's a whopping 15 degrees outside and snowing. How can it snow at 15? Go figure. Talk to you soon.